we have a few clients who aren't billionaires yet. Founder and chairman of Adams Street Partners, our distinguished guest speaker has introduced a number of highly successful private equity investment strategies. It's also the first fund for institutional investors. Over the last 41 years, Adams Street Partners has grown to be one of the largest private equity firms globally, with 10 offices worldwide. A wildcat to the core, our speaker achieved both his BA and his MBA from Northwestern University and has served as a trustee for decades, chairing the highly successful Northwestern Investment Committee. So, also he's been on several boards and committees and recently chaired the Chicago History Museum. I don't think you'll find it in his biography, but he swam against Mark Spitz, and I'm not sure who won. So it's with the greatest pleasure we welcome back one of our most popular speakers and a very good guy, CFA T. Bondurant, Bond French.
Thanks, Jim, for that generous introduction. Yeah, I never really saw Mark Spitz in the pool. It was just his bubbles, actually. I was a freshman on the Northwestern swim team in 71, 72, and he was a senior at Indiana. And a few months after the college swim season ended, he swam in Munich at the Olympics and won 7 gold medals, so I wasn't even close. But I am proud of my time at Adams Street. Adams Street is nearly 50 years old. We started in 1972. It's part of the trust department of the First National Bank of Chicago. I joined in 1980, 41 years ago. So it's a pleasure to present an update on the private equity industry. Kim Augustine asked me to cover the history of the private equity industry, an update on the buyout business, an update on the venture business, an update on the secondary business, the co-investment business, the private credit business, an update on the history of Adams Street, and what's going on more seriously with climate change and ESG initiatives and DE&I initiatives. And so I'm going to try to do all that in 35 minutes, but I'm available for questions after that, which I would encourage. Adams Street just does investments in private companies. We're not a hedge fund. We don't invest in real estate. We don't invest in infrastructure or timber or farmland or other things that are in the alternative bucket. It's just private markets, equity and credit, and it is global. And we have 460 clients. It's almost all institutional. We have 235 employees. We are 100% employee owned. And I'm also very proud of the fact that we've set up a compensation system that allows 100% of our employees to have ownership in the firm, including my assistant, the receptionist at the firm, and so forth. So these are, again, not temporary or it doesn't include part-time employees, but all full-time employees are eligible. Adams Street have five investment teams. We're a strategically integrated platform, and a lot of firms and people say this, but we've really backed it up with compensation alignment. As I said, every person, literally, at the firm is an owner. We have just one bonus pool and one profit center. It doesn't matter what team you're on or which of our 10 offices you're in. We share carry allocations across the teams and across the firm as well. So whereas, let's say there's carry on our secondary fund investments, that team has the majority of that carry, but also the other investment teams participate in that carry, and the firm participates in that carry. And every unit holder receives the benefits of those successes through the ownership of their units because the firm has part of that carry. So that means the accounting team, the legal team, the HR team, all teams that support our activities and work very hard to secure and close transactions can celebrate the wins and their contribution and hard work to support everyone else. The first team was the growth equity team in the lower left that started in 1972. We were just a direct investor in venture-backed companies. Remember, back in the 70s and the 80s, the bio business didn't exist. So we were 100% in venture. And we were not so-called fund of funds then. For the first 7 years of our existence, we were just a direct investor, a so-called real venture firm, serving on the boards of companies, helping entrepreneurs start their businesses, and living through all the highs and lows of that activity. Was successful, and to expand our efforts, in the late 70s, we wrote a white paper, which I still have, in 1978, that suggested we take, with our clients' permission, some of our direct investment money and allocate it to funds that we knew well now, after 7 years in the trenches, as a limited partner, both for return on its own right and access to more deal flow and relationships. And so we started that activity in 1979 in the form of a commingled fund, and years and years later, others have deemed that that's the world's first private equity fund of funds. Wasn't a notion that word wasn't invented until the 90s, but that's the case. So since then, we've invested in over 1,100 funds, 350 GP relationships globally. We serve on over 520 valuation committees and advisory boards. So we have a deep understanding and multi-decade relationship with many of the top venture and buyout managers. And that's critical for information flow, and we'll get into that in a bit. Secondary investments, we started 35 years ago. Huge activity for us. $7 billion under management there. Co-investments, we started, again, over 30 years ago, $3+ billion there. In private credit, we started 5 years ago. There's $6 billion under management there. And it's been a fantastic addition to our activities and very synergistic. So there's a tremendous amount of sharing here among the teams where the general partners are at the center of our universe because they are involved in all 5 of these activities. We're raising and investing about $7 billion a year. That is probably going to be greater this year. And separately, we as employees and as a firm have over $400 million invested alongside of our clients in the funds. We're not KKR, so that's a lot of money for us, but we've encouraged everybody to invest in our employee funds, which we raise as part of our standard fund, so people have the choice of doing that on an annual basis, and a lot of them over time, little by little by little, have put significant capital into our own funds, and obviously the clients really appreciate that, and so do the consultants, because there's a complete alignment of interest. We have 5 decades of experience. We started at First Chicago, as I said earlier. That became Brinson Partners in 1989. That became part of Swiss Bank in 95. Swiss Bank and UBS merged in 98, so we were UBS Brinson. And for Bank Holding Company Act reasons that UBS had, we were spun out in the fall of 2000 to form Adams Street. We were located on the corner of Adams Street and LaSalle Street in the Rookery Building, and that's where the name came from. It also helped, we wanted something that was close to the front of the alphabet, and we didn't want to name it after any people because we wanted to create, a 100-year enduring organization. And we also had clients in Asia at that point, and some of them found R's and L's hard to pronounce, and so we didn't want to name with that in it. We had an office in London rather, so if it sounded slightly English, that was good. So anyway, Adams Street Partners worked out very well. We have 10 offices at the bottom, 4 in the U.S., in Menlo Park, Chicago, New York, and Boston, 2 in Europe, in London and Munich, and 4 in Asia, in Singapore, Beijing, Seoul, and Tokyo. We have investments in 32 countries, every continent but Antarctica. We have employees from 25 countries, and that was true 20 years ago. So we speak more than 25 languages and dialects, and that was very intentional on our part. When we started investing overseas 30 years ago, 25 years ago, we decided we were not going to send Americans to Europe or Asia, that we couldn't replicate the wonderful reference network and relationships that we had in the U.S. just because we had them here didn't mean they were going to translate to France or to China. And so we decided, even though it was going to be a slower approach to growth, to hire locals and to build bit by bit over time with people that really knew the culture, knew the languages, went to the same schools and so forth. And that's turned out to be a very good thing, because the private equity business isn't public markets. It's all about people relationships that are key for deal flow and information. Just a couple of other quick things I'll highlight on this slide that I'm very proud of. And that is in 1985, and I was part of this, we chaired the first committee to produce the first performance benchmarks for the private equity industry. And in '85, we've been going for 13 years. We had a huge amount of data compared to others then. And we contributed our data to Venture Economics and convinced a number of other institutional investors to do it. And that's how the benchmarks first got started. We recognized that private equity wasn't going to become an asset class unless we had benchmarks, valuation standards, and reporting guidelines. None of those things existed. So it was really back then in the 70s and early 80s kind of mom and pop situation. And we helped institutionalize it. The second thing we did in '88 was chair a committee. My boss, Bart Holliday, did this, God bless him, that had a combination of LPs, GPs, accounting firms to establish written valuation guidelines, because they were all word of mouth up until that point, and it was hard to compare funds if they had different standards for value their companies. And so we put that to paper in a 2-year project that then was widely adopted. And in '92, I was on a committee with AMER and the CFA Institute to establish the reporting guidelines, how you calculate net IRRs and so forth and so on, and what's acceptable in terms of, again, comparing performance. So all of these things resulted in 2000 in us being inducted into the Private Equity Hall of Fame. No big deal. But we were actually the first LP or fund of funds to be inducted. Prior to that, it was like KKR or Kleiner Perkins, or people that were on the GP side that were at the forefront of their industries. And we were very proud of that fact. And in the citation, it wasn't just we'd had great performance, which we did, and good client service, and we're honest and ethical and so forth, but it was all these things that we did to contribute to the formation of the industry that was important. The evolution of private equity, this is 70 years of history on one piece of paper. I'm not going to go through it all. We could have entirely total different or lengthy luncheon presentation on the history of the private equity business, but it really began after World War II with the Rockefeller or the Venrock funds, with Whitney's, with many other major wealthy families and foundations starting to invest in the venture space, accompanied by high net worth individuals, and later on by insurance companies, Northwestern Mutual, Connecticut General, Prudential, John Hancock, Mass Mutual, many others in the 70s were major investors here. But honestly, the origins of the industry go back much farther than that. I mean, if you think back to the 1860s, 70s, and 1880s, railroads were brand new, the oil business was brand new, the steel business was brand new, and private families and other institutional investors were many of the equity sponsors of these businesses that were being created all over the place. And they were some of the first users of the capital markets on Wall Street with debt financings and eventually public stocks, but to get started they needed private capital. So it goes back a long time. And even into the 30s, Venrock and the Whitneys were funding the beginning of Eastern Airlines and TW Airlines and Lockheed Martin and so forth. Well, it wasn't Lockheed Martin then, but or McDonald aircraft manufacturing, things that were brand new then. Boeing, had Mr. Boeing, Bill Boeing, who started Boeing in Seattle, was a boat builder, and turned out all the things that were important in building boats in terms of skills were critical in building airplanes and airplane wings. So he got private equity. And if you really want to go back in time to 1492 and Christopher Columbus, Queen Isabella funded, with real money, those 3 ships and that voyage. And in turn, she took a profit interest in anything they might discover and the riches that might happen. They were hoping to find the New World. Well, they didn't know they were going to find the New World, but they were hoping to find a short route to Asia, and were hoping to bring back spices and gold and silver and so forth. And she got a carried interest out of it 500 and some years ago. And it went on for years because that was the agreement. So anyway, that's not a new concept, to have a profit interest in your entrepreneurial endeavors. The last thing I'd mention on this slide, well, a couple things. One is the industry's expanded in its breadth. Was just venture, as I said, mid to late 80s, the buyout business came along, then distressed debt investing, other kinds of specialty, mezzanine investing and so forth and so on, secondaries, co-investments and all that expanded in that sense, but also expanded globally. This is an industry that started in the US, morphed into England and Europe in the early 80s, and then into Asia in the late 90s and certainly in the 2000s. So today it's global. If you were to ask me how many managers, private equity and venture managers are in sub-Saharan Africa, there are over 60. Many of them are on Fund 4, and they've done very well. How many venture managers are in Vietnam? 25. I mean, who would have thunk it? So many of the governments around the world have realized that the U.S. had a brilliant capital allocation model here in venture and private equity. Equity, risk capital, not debt. And active management with people serving on the boards, helping entrepreneurs, commercializing technology, and transforming industries or creating new industries, and creating huge numbers of jobs. So they want to replicate in their own home countries. And so little by little, they've enacted legislation and promoted policies to do that. And obviously there's smart people everywhere and there are entrepreneurs everywhere. And so that's why we have investments in 32 countries. Last thing I'd say is in the 70s, there was some pivotal legislation that helped the growth of the industry. Both happened to come in 1978. And one was the Steiger Amendment in Congress that reduced the capital gains tax rate, which then was 50%, down to 28. And Congress wisely understood that there was a big difference between capital investment and ordinary income in terms of the risk that's taken and the importance of having, creating an environment that's favorable for people to make investments, particularly in risky ventures where they don't all work out. But if you spend 30 years of your life building a business, then when you sell it that one day, you're a millionaire. But in between, you may not be at all. But it wasn't fair to have a 50% tax rate because it was discouraging not just investment and capital formation, but it was also discouraging entrepreneurs, from starting business and taking risk. So once that was passed, beginning in the late 70s, a lot more money started flowing into private equity and venture. Obviously, Congress has a different view today, which I totally don't understand, honestly, from an economic point of view. It would be very detrimental to so-called equalized capital gains and ordinary income. I mean, and it's not self-serving, it's detrimental to the country, and to job creation, and to innovation creation. The second thing that happened in '78 was the Department of Labor clarified a prudent man rule, the ERISA prudent man rule that started in '74. And the prudent man rule said that a trustee of a pension fund could be held personally liable if they made imprudent investments. And this was trying to get at unions and some other places where they would take union money and invest it in some friend's restaurant or whatever. But, and there were other issues, but anyway, that prudent man rule came about in '74. But a number of very sophisticated law firms looked at that language and said, deemed that venture capital is an illegal investment for pension funds. Again, this just covered corporate pension funds, but the public pension funds wanted to be treated the same way. And so after 4 years of testimony, in particular by people from the big corporates, General Motors, IBM, GE, Shell, others, who already had some venture allocations and understood it well, the Department of Labor clarified in '78 their explanation, and they held that the definition of prudence was along the efficient frontier at the asset allocation level, not at the individual deal or transaction level, because obviously venture is very risky. Roughly 45% of the investments that our venture managers start out with fail. And we have some of the best venture managers in the world. So not everything works. Obviously, drug trials don't always work, et cetera, et cetera. So that clarification was critical legally to allowing states and city and county pension funds, as well as all the other corporates. AT&T, I should have mentioned, was big as well as an early venture investor, to commit more risk capital to this asset class. So what's happened in the last 40 years? This is just 20 years of it, but this is the size of the market. I never, ever 40 years ago would have dreamed it'd be this big, but it's big. It's $7 trillion today with $2 trillion of dry powder. And this is a result of the fact that really through thick and thin, the industry has produced outstanding investment returns and has attracted outstanding people, both as on the investor side, as general partners, management teams, entrepreneurs, and so forth. And part of it, particularly in the last number of years, where you see these bar charts expand almost geometrically, is driven by Fed policy or monetary policy, and globally. Again, these are global numbers, okay, not just U.S. U.S. is roughly 60% of this. Europe is roughly 23, 24%, and Asia is about 16%. So there's rough breakdowns there. But with interest rates that are negative or near zero, it's forced, as you know, it's an old story, but you know very well, since 2009, people that have to take more risk to earn a return on their endowment or their pension fund. Even a 7% return looks difficult to achieve, given where rates are and public equity valuations. So that's propelled a lot more allocations to private equity, where there is a risk premium for illiquidity. The liquidity itself is a risk, but if you're getting paid 300 to 500 basis points to take it, that looks pretty attractive now. So that's one of the fundamentals. The other thing I would say is the innovation economy. So venture and even the buyout funds who invest in healthcare and technology, software, and so forth are fundamentally funding new innovation, and they're doing it at the very beginning. And today, the venture firms are holding their portfolio companies much longer. The accretion of value is accruing to the private investor, and by the time they go public, much of the run-up in valuation, like in a Facebook or whatever, has already occurred in the private market. So what's happening annually in terms of fundraising? The same story here. I mean, there were ups and downs. In 2000, it looks small now, but that was the internet bubble. And the dark line on the top is venture, the light blue line, powder blue line, are buyout fundraising. Again, there was another peak, mainly buyout related fundraising in the mid 2000s, 2006, 7, 8. The global financial crisis, caused a lot of things to come to a halt. The private equity industry wasn't, a cause of the global financial crisis in any way, shape, or form. And actually, almost very, very few defaults took place, which kind of punctured another myth that it's just a highly levered industry. If it was just a highly levered industry, then there would have been a huge number of defaults, but that didn't happen. We'll get into more of that in detail. But then we've seen steady growth since 2009-10 for some of the reasons I just mentioned. In 2020, there was a fall off in fundraising for obvious reasons. Everything came to a halt the first and second quarter of 2020 with COVID, but it's roared back now. So Large mega funds are back. There's lots of new allocations of private equity for the reasons I already mentioned. I'll just say one thing that's kind of humorous. I started in 1980, which is 10 years off to the right here, not on the chart. But in my first year, $1 billion was raised. And I thought that was a ridiculously high number because only 5 years earlier, in 1975, you'll never guess how much the entire venture industry raised. Again, remember, buyouts didn't exist. 30 million, the whole industry. 19 of it was in one fund, IVA, Institutional Ventures Associates by Reed Dennis. This was impossible in the mid-70s. You'd had, a 2-year bear market in stocks, particularly growth stocks, had fallen for 2 straight years. When I was at Kellogg, I graduated in '76. Every time I took an investment class and you had a paper portfolio, I lost my ass. The stock market went down every quarter I was in school. And so when I went into the investment business in '76, people said, you're crazy. Everyone wanted to be an agent, go to Wall Street or be a consultant or something. They didn't want to actually be responsible because it was so risky. So anyway, venture was risk on steroids, and only 30 million was raised, the whole industry. This is, again, one of the things that Congress reflected on. And so 1 billion was raised in '80, and then only 3 years later, in '83, 3 billion was raised, and that's the first time I heard too much money chasing too few deals. Now, people have been saying it for the last 40 years, but I'm kind of tired of it. I've been hearing that for 40 years. But 3 billion wouldn't even measure on this chart today. All right, why invest in private equity? I won't spend a lot of time on this, but it does have attractive risk-adjusted returns. It's not highly correlated to the public markets. We estimate, and these correlations change over time, different cycles and so forth, but we estimate a correlation of about 0.6 for venture to public equities and about 0.7 or 0.75 with buyouts to public equities. And those two asset classes aren't necessarily correlated with each other either. So if you think about the level of interest rates being super high or super low, that affects the buyout business, definitely. It has no effect on venture because there's no debt in venture at all. If the stock market is high, that's competition for buyout funds because it sets higher valuation for doing new transactions. That's really an exit mechanism for a venture. High valuations are good in this sense for companies that have gone public and hopefully are performing well. But it doesn't really affect the going-in valuation so much because you have a startup. You have nothing. You have a sheet of paper. I mean, there's no revenues, there's no earnings, there's no balance sheet. There's just a couple of people that have an idea. And so, and if it goes public, it might not go public for 7 or 8 years or 10 years from now. So whatever the current stock market is, it doesn't matter. I don't even have a screen in my office that has a stock market during the day. It doesn't matter to us. We're looking out 5 or 10 years on things. There's always going to be election cycles, there's going to be economic cycles, there's going to be weather crises. There always have been, there always will be. So we're not caught up in the events of the day, just trying to look out over a much longer term. And so it's listed as a con here. It's a long-term illiquid investment, but I love it. During the global financial crisis, there's no liquidity for us. But we didn't expect any liquidity. Everyone else expected liquidity out of their commercial paper and their bonds and their stocks. We didn't. So all of the structures in private equity are set up to be illiquid, which means nobody can withdraw from our funds. So we didn't have to even think about funding somebody who wanted to get out. And it saves the investors and it saves us through these downturns. In fact, because we have a very well thought through portfolio construction program, and I'll get into this in a minute too, we had dry powder, cash available to invest in 2008 and 9. And so we were huge buyers in the secondary market of top-tier venture and buyout funds, particularly in the fourth quarter of '08, when a lot of major universities had to raise capital for their endowments. And I remember one weekend we were bidding on 25 things at a time. So we and this is Harvard, Yale, et cetera, et cetera. So we, I think in the bottom, in the fourth quarter of '08 and '09, we bought like $750 million worth of secondary interest in the top firms because you couldn't get a bid on a lesser known name. So it was the top firms that were selling. People were forced sellers. So anyway, I love the fact that I don't have to worry about a sell decision, and we space out over time our buy decisions so we can average over valuation cycles. Anyway, that's more than you want to know. One thing I will say, the media, I mean, one of the issues is supposedly lack of information and intransparency and opaqueness. And the media would talk about this, or members of Congress possibly. But for an investor in the funds, we get more information than you get in the public market. We know exactly what's going on with every single portfolio company. We know exactly what the debt levels are quarter by quarter. We know exactly if they're about to breach covenants. We know what, we get to meet with management teams on a regular basis. They bring them to the annual meetings of the funds. They make presentation. It's all inside information. Now, it's all private companies. We're not violating anything. But we have forward-looking 4 or 5 year plans of what they're going to do. We're aware of pending acquisitions. We have so much more information than is available in the public markets. I don't know what I would do if I were, as a professional in the public markets, because I just don't have access to the same data and the same information that we have in the private markets. So, anyway, it's much better system, I think. So we're not investing on hope, we're investing on real knowledge about how things are going. The other thing I would say is governance. The investors are all around a small table. The board, the shareholders, the management team. It's all one and the same. The managements have a much bigger stake in the company than typically in the public markets. And the directors are the shareholders. They're not representing shareholders, they are the shareholders. They don't have quarter dog and pony board meetings. They have working meetings maybe on a monthly basis. They might be talking to the CEO on a daily or weekly basis. And they might be helping with introductions to new customers and suppliers or possible add-on acquisitions, or helping to finance those things. And so this is very, very helpful to the management teams and to the governance. And by the way, the directors then are the ones that hire and fire the CEO, and it happens. But they can tell right away if someone isn't really performing. It could be a CFO, it could be another executive, or whatever. But they're active in recruiting people to make it a better company. And so it's a little bit reverse from the public markets, where often the CEO chairman is the one picking the directors. Here, the directors are really holding the management accountable. I won't dwell on this too much, but there is a trade-off here between liquidity and the duration and holdings and so forth. So private credit, in the lower right would be compared to everything else, the lowest return, but the shortest duration asset. Secondaries would be higher return, a little longer duration. The point of this, without getting into lots of details, is that in terms of portfolio construction, we can pick from these different things that have different risk and return characteristics and different holding periods and different potential upsides in terms of multiple and IRR. So we can tailor a private equity portfolio to a particular client's needs and wishes in terms of their own risk tolerance and so forth and so on. Access to good investments is very important, so I won't dwell on it, but essentially 100% of everything we did in 2020 was oversubscribed or GP influenced. So this is back to the importance of those relationships and getting the first call. So you obviously can't just look something up and invest in it. These are returns. I'd love to spend the whole rest of the presentations dwelling on this. I think I'm going to frame this slide. These are the 1-year IRRs. This is for the entire industry. This includes all the fourth quartile performers. Adams Street's performance is better than this. For the 1-year period ending June 30, the U.S. venture industry returned 94%. U.S. buyouts, 50%. European private equity, 46%. That's in dollars, by the way. If you convert that to euros, it'd be a higher number. Asian private equity, 43%. The total was 53 for the 1-year period. So, looking back over longer time periods, it's remarkable. The other thing that this brings out is all measurement periods are depending on the start date and the end date. And I look at the 20-year venture return here, 10.3% compounded for 20 years. I gave this presentation 4 years ago at Jim's request, and of course, he asked me about every 4 years, so it's just long enough I have to start all over again preparing. But 4 years ago, the 20-year number for venture was 25% compounded. Why? Because it included the upside of the internet bubble. Why is this 10? Because all that's off the chart now, and you're just starting with all the down years from the top of the internet bubble to now. And so, anyway, statistics can be misleading, but it's interesting to see how much even a 20-year number can move in a couple of years. Okay, buyouts. I gotta keep moving here. We'll do so. So, this is buyout transaction volume, how many deals were done by firms. You can see 07 was a crazy time with valuations high too, dropped almost to nothing in the global financial crisis, and it slowly crept back to larger levels. But the GPs learned a lesson in the global financial crisis, about being more disciplined on valuation and leverage levels and so forth. And so they've been, as a group, much better sellers over the last 4 or 5 years than buyers. Now, if you look at the last bar chart here on the left, that's just the first 2 quarters of 2021, 190 billion. So if you double that, this 2021 number is going to be way up there in the sky, and so that worries us. I think people feel that interest rates are going to stay low forever and inflation won't be a problem. So dry powder is this chart. The blue is our mega funds. That's where more than half the dry powder is in a very small handful of funds. Mid-market buyout funds are in gray, and zillions of small buyout funds, like 1,000 of them in the U.S., are in the dark bar charts there. Here's what the impact has been on valuation levels in the buyout world. This is enterprise value over EBITDA. You can see it peaked in 07 at 9.7 times, dropped, and then slowly came back over 5, 6, 7 years, and now it's roughly averaged at 11 times for the last 5 years or so. So, as we'll see in a minute, as these valuations have gone higher and higher, commensurate with the stock market valuations going up and up, and many of these are growth companies, remember. So there's a premium valuation for software companies and so forth that's baked into these numbers. But the GPs have had to put more equity in because, as I'll show on the next slide, the debt levels have not increased. One of the reasons, or the ways that general partners have been able to live through this environment and still earn great returns is that they've done a lot of add-on acquisitions of their platform companies, and often these smaller add-ons are done at much lower multiples. And so while this is the going in sort of platform multiple, over time, over 3, 4, 5 years, the average cost is much lower than this number as they've expanded the enterprise. Also, with very low rates, it's allowed portfolio companies to borrow money to do dividend recaps, and there's been a huge number of those. And that's gotten people, money back very quickly. These are the debt leverage multiples that I referred to, and you can see they're no higher than they were in the financial crisis, and they've basically been the same for the last 8 years. So not an over leveraged situation. Cov-Lite loans have contributed to this too. 91% of the broadly syndicated loans, highly leveraged loans, are Cov-Lite. So that's been a huge benefit to the buyout community. Now, we talked about private equity being illiquid, but look at this. The blue bar charts are the distributions from our U.S. buyout managers, and the gray are capital calls. And so this has produced positive cash flow for 12 years in a row. Because there's so much positive cash flow, many LPs are rolling this back into new commitments to maintain their allocation. But if you look at the numbers on the bottom, you may not be able to read them very easily, but starting in 2010, what this is the percent of a beginning year net asset value that was distributed. 2010, it was 24%, next year 20, then 22, 22, 31, 30, 28, 33, 28,
28, 27. So even in the global financial crisis, in 09, 5% of beginning NAV was distributed. In 08, 7. So even in the worst possible environment, it was cash flow flowing. And so we can say it's an illiquid asset class, but you know, if I had a bond that was, I mean, these average in the high 20s. If I had a bond with cash flow in the high 20s, I'd be pretty darn happy. And that's essentially what this is amounted to in a highly well-diversified portfolio with excellent managers. So it's again, one of these things that's slightly mythical about illiquidity. This is a chart we started years ago. It shows a complete inverse relationship and perfect inverse correlation between credit spreads and buyout returns. These are one-year buyout returns linked together. Left side represents the spreads and the right side represents the returns. Lots of wiggles, obviously, but if you look at the last decade, from the global financial crisis to now, and the blue wiggles there on the right, they average around 16%. Guess what? That's what the 10-year buyout return has been. So right now, credit spreads are an all-time low. Credit's widely available. Obviously, that's fueling returns here. I won't go through all this stuff, but there's so the summary in the buyout world is that deal activity is very strong, valuations are high, fundraising is very strong. Many businesses performed very well through the pandemic and are trading at premiums after. There's significant dry powder waiting to be deployed. Managers are scaling their fund size, they're offering new product extensions, they're coming back to market more quickly. And you can see on the right though, the black is the debt in these deals and the gray is the equity. You can see that as valuations have risen, this just shows the point I made earlier, more and more equities contributed to the deal, not debt. And so the safety of the situation is very good. Venture. So this is venture fundraising for the last 30 years. It's obviously gone up a lot. It peaked in 07 or 17, 18. In particular, if you look at the light blue chart, bars, that's fundraising in Asia. The black or dark blue at the top is US and green is Europe. And this is China, really, and the explosion of R&D funds, which we can't invest in China. And then the R&D market has dropped dramatically, which has affected these fundraising numbers. But with that as an aside, the US side is increased in terms of the number of dollars raised. And the real haves and have-nots in venture, I mean, that everybody wants to be in the top firms. Well, guess what? 80% of the money raised goes into the top 20 firms. And there's hundreds and hundreds and hundreds of venture firms in the US. And the other thing that this doesn't capture, is really the whole market. So these are just independent managers raising money. This doesn't capture captive funds that are inside of banks and insurance companies or corporations that have corporate venture funds like Intel Ventures or Microsoft Ventures or whatever. And it doesn't capture what hedge funds and mutual funds are doing to invest. So there's way more money going into the venture business, particularly on the growth pre-IPO side of things, late stage side of things, funding capital and capital innovation. Exits have increased a lot. The chart on the far left is 2008 to 2011 annual average, 130 exits, big exits, 100 million or more in IPOs. That doubled in 2012 to 2015, went up again in the late teens. It's even higher in 2020 and even much higher in 2021. If 2021 carries on at this pace, there'll be over 500 major exits for the venture community. And some of these are huge exits. So, venture is all about the innovation economy, investing in cloud computing, mobile, big data, artificial intelligence, machine learning, security, and infrastructure, and so forth and so on. So, the thing that's really helped venture, particularly, is COVID. Caused society, both personally and business-wise, to probably, this is well written about, so this isn't Bond talking, but probably we all moved forward 10 years in terms of technology adoption in 3 months last year. And so My wife doesn't even have to leave the house now. She's constantly shopping, it's just ridiculous. Packages arriving on a daily basis. So anyway, my 91-year-old mother last year was ordering groceries online, delivered to her house. Are you kidding me? She never, ever would have done that before. And we're all using Zoom and everything else like it's always existed. So anyway, this is really, and then healthcare we haven't touched on, but again, huge acceleration in commercialization, development of lots of things. So, secondaries. Secondary markets steadily grown. It's natural. I mean, about 3% of the total assets in the industry change hands every year. So as the industry gets bigger, which you've already seen, the secondary market's going to get bigger. Big change in the last couple of years is so-called GP-led transactions or continuation vehicles or other things where the GPs are doing some kind of reconstruction of their fund or wanting to continue to hold out into the future a really successful portfolio company but give the investors options for liquidity or to roll over. That's now 60% of the secondary market. Pricing's high today in secondaries. It's still inefficient, right? There isn't a centralized platform, so it's all different organizations trading with each other. But LBO pricing today for LP interest is probably 90 to 100 cents, sometimes more, for a great fund. And venture capital pricing's low. It's more like today, more like 70 to 80 cents. But it's not for the reason you might think. It's because venture valuations are so high, privately marked up, not yet public, that in the secondary market, people are discounting those super high valuations of private holdings. And so I would say a year or two ago, that might have been 80 to 90 cents. There's always a discount for venture because a lot of secondary players won't buy venture. A lot of the outcomes of these companies are hard to tell. They're bimodal, if the FDA approves or not, a particular drug trial. So everybody will buy buyouts. So anyway, because of our heritage in venture, it gives us a leg up there in terms of understanding those transactions and getting preference. The other thing is the GPs, have to approve the new purchaser. And so not everybody's on the approve list. Guess what? We are. And so a lot of times the GP will call us and say, we got an LP that wants to sell and we would love to have you buy that interest. So there's a lot of, in that way, there's a lot of inefficiency and not everything is auctioned. I'm going to skip this slide in the sake of time. Talk about co-investments. This is big. I mean, it's a positive thing for both the investors and the GPs. For the investors, it allows people to put more money with favorite GPs in the same deals at a lower cost because usually there's no fee and carry on the co-investment. And in our case, which is all that's true for us, we charge a fee and carry on our funds, but it's low compared to the primary GP. It'd be like 1% on invested capital, which is a much lower fee than 1% on committed capital, and a 12% carry with 8% pref. So it's one of the lowest cost ways for institutional investors to put more money out in private equity, again, alongside a very astute lead investors. So it's going at the same time on the same terms. And for the GPs, it provides additional equity firepower and allows them to better manage their own portfolio concentration so they can buy a bigger transaction and bring in some of their LPs to invest with them, not bringing in some of their competitors to do a so-called club deal, which they hate doing. So there's more dry powder here. And I'm going to keep going. And one thing I would say about Adams Street says disciplined growth underwriting. We only do about 1 out of 10 co-investments we see. Some people are surprised by that. We don't do every one, even though they're often with GPs that we're with. So we spend a lot of time doing our own underwriting and deciding, what we're going to do. So we're literally cherry picking what we think are the companies that have a better risk return profile, particularly in a high valuation environment like this. So and we've tracked the deals we've turned down, which are like 90% of the deals, and how they've done versus the ones that we've picked and we've done better. So there's something to the analysis. Private credit, we're It's a very successful strategy for us. We're not investing in the wide blue ocean of private credit. We're just investing directly in companies, not in other funds, that are private equity backed. And we're not even investing in all private equity backed transactions. It's just middle market ones. And the definition of that is companies that have an enterprise value between 150 million and 750. So they're big enough to be not too fragile, but they're not so big they can access lower cost capital on Wall Street through a broadly syndicated loan or a high yield bond or something like that. The result of that is that our portfolio, the net leverage in our portfolio is 4.6 times. It's about a turn lower than the industry. And there's a 55% equity cushion in our credit portfolio. So the valuations could fall by half and we're still money good. And I should hasten to add, it's not a mezzanine strategy. This is first lien senior that we're doing, and the current unlevered return on our current portfolio is 8.3%. So it's 80% first lien and 20% second lien. And lastly, unlike the industry that's 91% Cov Light, our portfolio is 82% with covenants. So again, a totally different profile and things you don't read about in the paper. And over the last 5 years, it's been a very good time, but we happen to have a zero loss rate. So I won't go through this slide, but this basically argues that the banks are holding less and less in terms of the loans. There's a record demand for more credit. Financing's good. And on the pie chart on the bottom left sums all this up, that there's $1 trillion of debt financing demand over the next 5 years versus private credit dry powder of 119 billion. So about a 9 times more demand for debt than exists. So people say, oh, there's too much money raised in private credit, but not by this math. Institutional investors are still allocating money to private equity for the reasons I mentioned. There's a little bit of issues right now because of these huge performance numbers. In many cases, institutional investors, endowments, and so forth are over their private equity allocation, because of performance. So they're trying to figure out how to get into balance. Some of that, because the secondary market is strong, some people are managing those over allocations through targeted sales. But more and more people, even first-time investors in private equity, have never had an allocation before. It could be sovereign wealth fund, it could be family office or whatever, are calling to invest. And so literally our phone is ringing off the hook here with people globally that are interested in the asset class. So as a generalization, I'll show this on the next slide. People are increasing their allocations of private equity. You can see family offices have a current targeted allocation in the high 20s, endowments in the 15% range. The larger endowments, Yale, Harvard, Northwestern, et cetera, those endowments at Princeton, Stanford, et cetera, those endowments have allocations that are in the high 20s and low 30s, twice these numbers. When I looked at this slide from 4 years ago, almost every one of these categories of investors was about 200 to 300 basis points lower. So over the last 4 years, they've increased wherever their starting point was, they've increased, every one of them has increased their target, and they've increased their actual AUM in the asset class. This sort of says the same thing. Part of it is, low rates, of course, cause pension funds to have a lower discount rate, increases your liabilities, and so there are funding issues. And the excess liquidity from central banks has increased all asset valuations. And so, again, getting paid a liquidity premium is a good thing. I'm almost finished. Adam Street's overweight to venture, particularly in mid-stage tech and healthcare. We're overweight to the growth equity space, where you have companies that have huge markets and category leader potential. In buyouts, we're overweight to the small and mid-end and underweight to large and mega. We're focusing on GPs that employ modest leverage because we think rates are going to go up, and we're worried in that sense about over leverage. And then with credit, private credit, again, as I said earlier, it's specifically focused on the small to middle market. And again, this is almost all GPs we're with. And so we have extra information from other private credit participants, because we know what the general partners are thinking in terms of how they're going to manage the company and what the future is about. And we're first lien senior. This says that everything is robust. And I'll wind up with two more slides. COVID impact on Adams Street. Like everyone else, on moment's notice, we had to shift from work from home in March of 2020. That led to, I never heard of Zoom, and I live on it, to a transition to a virtual environment. And we had, again, 10 offices and 5 investment teams and legal and accounting, HR, and so forth. Last year, 2020, was a record year for us, not only in terms of return, but new money raised. And this year is going to be even bigger. So many people are going, oh, we're doing so well. Why do I need an office? But it is important, because we've hired a lot of new employees, and they haven't had the one-on-one mentorship or training. Even mid-career people, need mentorship. It's this apprentice business in private equity and venture. So we're anxious to be back together in person. We hosted many webinars for our clients, and the irony, and this is again true for a lot of people, we have greater attendance, of course, virtually than we would have for in-person meetings, much greater. We've produced 20 thought pieces in the last 18 months and so forth. The bottom is important too. We've done a couple of things. A lot of this is in relation to George Floyd and others, the climate change and so forth, but we've increased dramatically our DEI initiatives, and I'll talk about that in a minute, as well as our ESG initiatives. And the industry has too on both counts. It's very serious about both. On this page, we talk about charitable giving increase. We've always had a charitable giving committee. It started 25 years ago. Again, this is our own money. It's a partnership. And so our focus is, and always has been, on educational causes for inner city youth. We figure the Symphony is well-funded, Northwestern's well-funded, so lots of good charitable causes, but we want to focus, again, this started 25 years ago, on educational causes in the inner city, and we're doing even more now. So we've upped significantly our charitable giving budget, and everybody's happy with that. We also do matching gifts 2-to-1, up to $5,000 per employee to support their activities and what their passions are. So everyone feels good about the company's contribution. On climate change and ESG, we signed on, we're a signatory to the Principles for Responsible Investment in 2010, 11 years ago. So it's been a long time we've been thinking about it. And we have a policy that assists all of our investment teams in considering ESG factors. This is with GPs and with individual company investments and so forth. We have a director, a full-time director, Johan Hill, who happens to be in our London office, and has like 20 years of experience in dealing with ESG and climate change matters prior to joining us. But he's our director of ESG and responsible investing, and he oversees our ESG efforts across all strategy, chairs our ESG committee, and each investment team has a representative that sits on that committee. We score all of our companies and all of our general partners with a consistent methodology on their ESG and sustainability ratings. And we did an analysis of our 2016 to 2018 global funds, which are old enough to be fully invested, that shows our portfolio has a 40% lower carbon intensity than the relevant like-for-like S&P benchmarks in the same vintage years. So we're proud of how seriously everyone's taken it. And lastly, internally, we've dedicated our efforts to decreasing our own carbon footprint. So all 10 offices have a dynamic recycling program in place. People are encouraged to reduce landfill and water waste. We installed water-efficient taps in our bathrooms and kitchens, and we use culture plates and napkins that are eco-friendly and compostable material. We also endeavor to communicate, forced to now, by email and phone, and video where possible to avoid excessive emissions with air travel and car travel. So our building here in Chicago, UBS Tower, is deemed as one of the most sustainable and energy efficient buildings and received a LEED Silver certification in 2010. So we're focused on that. It's, long road, but that's something we're very committed to. And D&I is very important. Now, if you look at these statistics at the bottom, it says Adams Street by the numbers. 60% of our employees globally are women or from diverse backgrounds, which means people of color. 54% of our equity owners are women or people of color. So it isn't lower level people, they're all includes very senior people. And 45% of the firm's senior professionals are women or people of color. So this obviously didn't start last year. This started 30, 40 years ago. Our first African-American investment professional was hired 30 years ago, and our first woman was hired 35 years ago. And so in some of our teams, there's so many women, when the HR department talks about diversity, it means hiring men. And I was in one meeting not too many years ago where there were myself and 3 women, and every one of them was pregnant. I was the only one not pregnant. But we're used to that, and we've organized around that. Well, what we've done, we've ramped up things in terms of working to attract and retain a diverse talent pool through internship programs and career advancement opportunities. We think that's important. And for the last 5 years, we've had 2 to 5 interns through SEO or 100 Black Interns, which is in the UK, or Chicago Scholars, or something called Breakthrough Tech, the Twigo Foundation. We've had 2 to 5 interns per year for the last 5 years, but in the last year we increased that to 15. And these are paid internships. So we think it's very, very important to build, a pipeline, if that's an overused word, of African American, Hispanic undergrads, who would consider moving into the private equity industry, which is what we'd really like. The other thing on the far right here, and I'll end with this, is our investments. We want to make sure that our general partners themselves have a diverse makeup of their employees and that they're promoting diversity within their portfolio companies, and that we also will back minority-owned or women-owned firms. Guess what? We started this 26 years ago in 1995 in a partnership with Progress Investment Management, which is a Black-owned firm in San Francisco, and helped then in the 90s and 2000s support the Black private equity industry. And so again, we've been at it for a very long time. So I'll close with that. I know we're almost out of time here, but I'm happy to take any questions. And I'm very proud of what we have achieved in all these dimensions at Adams Street. Thanks.
Thank you, Bon. Very fascinating history of the PE industry and overview of your business. We have taken some questions from folks that attended, and we also may have a few coming from our online audience as well. Bon, curious about the tax changes being proposed, in Congress. What are your thoughts on how that may impact both, your industry and also, small businesses?
Well, as I've already indicated, I think carried interest is very misunderstood. So it's a profit interest in a partnership. And what that means, if there's ordinary income in that partnership, it's taxed as ordinary income by the general partners. If there's capital gains in that partnership, it's taxed as capital gains. So it's not automatic that it's capital gains tax rate. And again, this has been part of the IRS tax code since the tax code was started in 1913. So it's not a loophole, it was intentional. On the debate about whether capital gains itself should be, increased, I obviously think that's detrimental, as I said earlier. Mm-hmm. What's going to happen, I have no idea. Okay. Obviously, Democrats don't either. I don't want to sound too negative there. It's obviously a very polarized society and very polarized Congress. And my fondest wish would be that we'd have more compromise in the middle. And I should, hasten to add, since it's almost a political question, is that I couldn't stand Donald Trump, and I didn't like a lot of the Republican policies that he administered. On the other hand, there are many policies, and this would be one, in the Democratic Party that I don't like either. And so neither party represents my interest. I'm very socially liberal and fiscally conservative. There's no one that represents me. And so we've got to get our country back on a more solid financial footing and not be this excessive debtor nation. And eventually that'll come home to roost.
Yeah, well said. I think you mentioned you allocate about $7 billion a year. Has your mix of how you allocate it across those 5 practice areas, presumably that's evolved over time, what areas maybe are increasing in terms of your allocation versus others?
Well, the clients are really deciding that. So many of them are sophisticated investors on their own, and they have their own teams that can invest in primary GPs, and they've had a portfolio for a long time. So they hire us just for co-investment or just for secondaries where they don't have that deal flow, or just for private credit. So it depends on the client interest. But in effect, so private credit has been increasing, in particular over the last 5 years since we started at a greater rate than everything else. But some clients who are in Asia want access to U.S. venture or buyout managers. Clients in the U.S. want us to provide them access to Asian managers. And so it all depends where you sit and where you are and what pieces of your private equity portfolio you might feel a need to hire us for. So it isn't like there's one top-down allocation that we're deciding on.
Okay, thank you. And one more question before we go online. This is a question on Chicago. Ken Griffin spoke at the Economic Club of Chicago yesterday and was a bit pessimistic about the city based on rising crime in the business environment. You, of course, have been active here for many years from a business, civic, and board perspective. Any thoughts you'd like to share on the city?
Well, I'm born and raised in Illinois, Peoria, Illinois. And I'm not involved in Chicago politics, even though I'm very active here on a lot of charitable boards, museum boards, university, and so forth. So, we've got to do better, on all the things you mentioned. Again, particularly with the school system. And that is the key to everything, to crime, to economic opportunity. And you're not going to have solve racial inequality or wealth inequality or whatever without really good school systems. And so, I could go on and on there because that's a real passion. But that's got to, yeah.
Question.
Sure.
A new question, not a follow-up.
Okay.
You take new questions?
Yeah, go for it.
So, curious as to your thoughts on China property developer Evergrande. It looks like an implosion just waiting to happen. The numbers are staggering. Given your global reach, do you have any thoughts on how it might play out, number one? And then if it turns bad, what ripples might occur in Europe or U.S. markets?
As I said already, we're not real estate investors. We have an office in Beijing. We've been investing there for a long time. We have locals there. We have a lot of investments there, and are mainly in venture, China venture. It's done very, very well for us. So all I know is what I read in the papers about it. I would guess, the Chinese leadership, for all the things that you might not like, are very smart, very well educated, and they're obviously in a huge conundrum now about how to manage this highly over-leveraged situation so it doesn't create a crushing blow on the 1.5 million homes have been sold that aren't built, to sort out. This isn't 100,000. This is 1.5 million homes that have been sold that aren't built. So, and people put deposits on, or they purchased the home already. So how they manage that so there's not a revolt. I'm sure they're going to have to put some money in somehow. I don't know. I would be pretty nervous if I were a foreign, bond investor, because my guess is they're not going to support those folks. But I don't have any insight into it. So I'm more worried. To me, that's almost the least of my worries about China. I'm much more worried about, China and the U.S. in terms of decoupling from each other, because my many visits to China, I was always pleased to realize that we were interdependent on each other on a lot of different levels. And now it's becoming less and less. And so the Chinese are very confident in themselves. They're convinced the U.S. is going downhill. And so I just pray that overconfidence doesn't lead to a miscalculation on our part or Taiwan's part or China's part. I mean, there are a lot of new regulations, as you know, since July 1st there that have caused $1 trillion of market cap to disappear. And it's hit the tech industry hard, the educational sector and so forth, some parts of healthcare. So a lot of people who live there have their heads spinning. And the Chinese are also implementing more regulations to clamp down on, privacy and so forth and so on. And so, to control more data, they're forcing, the big tech companies there to sell a golden share, which gives the Chinese government a seat on the board, and to actually embed governmental and specifically party employees in the tech companies to control the algorithms that shows, what can be disclosed and what can't be disclosed in terms of free speech. They don't. It's just a totally different system than ours. We care about individual independence and democracy at a greater high level. That's not their concern. So these worlds are colliding now, and that it really worries me.
Ron, you have time for a couple more?
Sure.
All right. Do we have one in the back? No? Okay, I've got
There
one.
was-
Oh, sorry. Yeah.
Well, I've given up trying to forecast that, and so, and a lot of people, you literally could have asked me that question 5 years ago, 10 years ago, 15 years ago, 20 years ago, 25 years ago, and so forth, because the charts looked the same then. And so, the beauty of it is that we can't undo anything we do, because it is all illiquid. And so the point here in managing risk, and specifically some of the risks you pointed out, is time diversification, not putting all your money to work today. And so if the market actually fell, the stock market or whatever, and private equity valuations fell, in some ways we'd be cheering, because unlike stocks and bonds where somebody hires you, they say, here's $100 million, you got a mandate, and that money gets to put to work right away in a fixed income portfolio or an equity portfolio. It takes us 4 or 5 years to do that. And that's something our LPs and the consultants know. They know that very well, but in this question sense, it's hard for them to integrate that into their thinking, because we're not investing in just today's market. We're investing in 2022. Somebody commits money to us today, 2023, 2024, 2025. So, and I don't know what's going to happen over those years, but those years are just as important as this year in terms of our portfolio construction. So that helps ameliorate. So if the market went down for the next 4 years, we've been investing at lower and lower and lower valuations. And yes, the things we've done, wouldn't look as well, but I didn't say this, but we're building in our models, lower exit multiples than we're going in at, and it still has to work, sometimes 2 turns lower. So we're not expecting to get out at today's multiples in anything we're doing.
We had a couple questions on access to private equity for smaller or retail investors. There's obviously rising interest in lowering the entry bar to PE, to enable more investment by smaller investors. How do you see that kind of evolving?
the democratization of private equity. I mean, I think, like for 401k plans and everything, it's very, very good. It should be done in a target date fund so that, T. Rowe Price, Fidelity, Vanguard, et cetera, but it's amazing. There's more to it than this, but it's amazing to me that a company will have a defined benefit plan managed with a completely different asset allocation than our defined contribution plan. It's terrible. And so if you're but it's all driven by who's sharing the risk. And so if a company is got a DC plan, they just want to show that's the lowest fee, the lowest risk possible. And in today's environment, with expected returns on equities being, 5%, let's say, and bonds being 2%, a 60-40 or 70-30 stock bond portfolio gives you like a 4% return or less. You can't retire on that. Right. You've got to have some other things in there, real estate, alternative, absolute return funds or private equity. So yes, they have larger fees and so forth, but the net return is the thing that's important. So, but anyway, many companies have tried to implement this and they've been sued, and many have lost those suits. So to me, that's one thing. The other is like wealth management firms, whether it's UBS or Morgan Stanley or whoever, are now offering private equity funds, including ours, to their mass affluent or high net worth individuals. And there's huge demand for that. Right. And the SEC and others are reducing the requirements to be an accredited investor and so forth. So, overall that's fine. We're involved in all of that and we're raising money through those channels. But again, the risk management comes back not just to the individual selection of our fund or somebody else's fund, but the portfolio construction and this time diversification. So that's the thing I worry about with individuals. They say, okay, I want an allocation of private equity. They put all their money in right now in one fund. It's not diversified. Our fund is diversified in its own right, but it's not the way a whole portfolio should be diversified, because you expect clients to re-up over various years and maybe in different things.
So
there needs to be a huge amount of education there that you can't commit your whole allocation today, that you have to, and we have to do this education again with very sophisticated pension funds, endowments, and consultants, that we don't want all your money today. We want it for your benefit to commit it over years. And so a pension fund, an endowment has, sort of a perpetuity, horizon, but an individual doesn't. So they may be thinking much shorter term, and that's probably the biggest mismatch there, because we're well suited to pension funds and endowments in terms of the duration of the assets and liabilities.
Great, thank you. Last quick one. Chicago Bears or Arlington Heights Bears?
I don't know. I don't know. I only know what you've read. I've been a Chicago Bears fan all my life, so it's hard to imagine. They used to play at Wrigley, obviously, but I don't know what's going to happen. No clue.
Great. Well, thank you very much.
We know some Bears very well, but I don't think they know either.
Well, thank you very much.
One more out here. A master limited partnership? Yeah, we don't have any. We've never talked about forming any. So, no, the answer is, well, again, that sounds like a real estate thing or something that happens with, midstream energy investments, pipelines, and so forth. But it's not, again, everything we do is illiquid. So it would be a false situation to somehow put a publicly traded liquid vehicle on top of all the investments that are completely illiquid, despite what I said about all these cash flows and everything. So you're asking for trouble, I think, if there was some structure like this. So we've never contemplated, never even talked about it.
Thank you very much.
Thanks.